Good morning, my friends. How are you? Talking about feeling hostage by your interest rate. I'm starting to hear a lot of people talking that, you know what, I bought my house with the low interest rate, but I hate it. I don't want to live here anymore. But I'm stuck here because I don't want to buy something with a higher interest rate. Also, we have some people being afraid about the rates. They're waiting for the rates to come back down to like 2 point something or 3%, and they don't want to move. They are stuck in that I want to wait for the low rate again. And so people are afraid of the rates. Right here we have one of my favorite lenders, Scott Marsh, is joining us today. Because when I talk about rates, talking about mortgages, I'm a real estate agent. I've been around for a while, but I'm not the one who produced the mortgages. That's Scott's department. So I'd rather have Scott, talk to you guys and letting you know more about the mortgage process, what the products are out there. Scott has been around. How long have you been around in the mortgage, Scott?
September was 22 years.
22 years. Wow, it's a lifetime for a lot of people.
Absolutely.
Yeah. And, we've been working together probably for like 5-6 years now.
Yes.
And I tell you, I'll give a lot of my loans to Scott because Scott knows how to put together the loans, knows how to do stuff, your experience, and, your advice to people. We'll get it done.
Absolutely. With mortgages, it's not just rate payment; it's the structure, what goes on behind the scenes, how to present the file to the underwriter, knowing the pitfalls we can hope to avoid, and how a file will go through processing and underwriting a lot cleaner.
Yeah, and that's why I like working with you because you do that really well.
Thank you.
And as well as educating our clients every time somebody has questions about the mortgages, we're well to educate them. Sorry, so this is why we're here, so you can help us educate our audience, all of our followers out there who have questions about this. And please share this knowledge. This is great. So share it with your friend if you find knowledge on this, or you know someone who feels that way. Well, I call them their hostage of the rate. They had a great rate. They hate their house because they bought the house in that moment where there was not much inventory. They went into a house that they didn't really like, they didn't really love, didn't really know the neighborhood, but that was the only thing available that they could afford or that they got an offer accepted at that point, and they wanted to get a lower payment. So they went in, and now that they're living there for a year or two, they don't like it anymore. They hate it. So let's talk a little bit about that. What are the options that somebody has? Let's say I bought a house in 2020 and I overpaid for it because I wanted the lowest rate. And now I'm stuck and I don't like my neighborhood. I don't like my house. I need a bigger house. I want a different school district for my kids. And I don't want to pay 7% rate because it's double what I'm paying right now.
So there's a few things. If you have the current home and you're thinking about renting that out, the rental, just like everything else, rents have increased. So the money you would get for renting your property most likely is going to be more than your current mortgage payment at that lower rate. So if someone isn't necessarily stuck, they could look to purchase a new home. Since you wouldn't be a first-time buyer, you could put 5% down. You don't need the 20% number. And then the money you'd be making on the rental of your existing home would help offset the higher mortgage payment with the current interest rates being a little bit higher.
Right. So you say, let me see if I understand this. Make sure we're on the same page. You're saying that I can rent my house because I have a low rate right now in my house. My payments are low. Let's say my payments are maybe $1,800 a month, and I know I can get probably $2,500 rent for my house right now, so that I can rent my house, get that cash flow, and I only need to get 5% to buy the house of my dream.
Correct. You would need 5% as a down payment. For mortgage qualification purposes, we would only be able to use the lease would only be able to offset the current mortgage payment. But if you're legitimately bringing in higher rental income because of, again, rents increasing, you would have that money as positive cash flow for the new house to help offset the higher rates.
So I'm building my wealth. Somebody's paying my mortgage that I have a low rate in the house that I don't like anymore, and I can move to the house that I want with only 5%, use some of that money to offset the payment. So I'm paying the same amount that I'm paying right now. Wow. That's like...
Yeah, it's not that hard. It's not that hard. Another thing too, right now, that the saying's kind of corny, but It's marry the house and date the rate. And what I mean by that is, yes, it would be a 30-year mortgage for most people, and your loan is amortized over 30 years, but your rate is not going to be for 30 years. The saying, what comes up comes down, that's 100% true here. We just don't know when. Is it 6 months? Is it a year? Is it a year and a half? Is it 2 years? So my point is, if you purchase a new house now with a higher rate than your existing rate of somewhere in the 2s or 3s, you're looking at a higher rate for not 30 years, even though, again, you have a 30-year mortgage. You'll be able to refi in 6 months, a year, 18 months, or 2 years and save some money that way. Just to give you an example, when I started in September of 2000 is when I got into this business. So literally, I think it's in November. So September, so just 22 years and a couple of months, interest rates were in the 7s. Right now, they've kind of actually settled and subsided a little bit. So they're in the low 7s to mid 6s, depending on your credit, your down payment. So everything kind of comes full circle. Now, I'm not saying in 6 months, 12 months, or 18 months, you're going to be back down to the 2s or 3s, but we might be from mid 6s to mid to high 5s. And then maybe a year and a half later, we're back down into the 4s again. So with purchasing a new home now with a higher rate, it's temporary. You will be able to refinance as long as you make that payment on time.
Awesome. I remember when I bought my first house, I was so happy. This is in 1995 because the rates went down from like 10 to a 7. And it was like, this is the time to buy. Never been this low before. And now everybody complains because they're in the mid 6s or low 6s right now. But this is the other thing that I always tell people. Sometimes we look at the rate, and yeah, lower rate saves you money, that's for sure. However, if you got to move, like you say, date the rate, marry the house. What's most important, the rate or the monthly payment?
Well, I mean, to me, at the end of the day, it's the monthly payment. The interest rate. If you want to brag at the Christmas party that you have a low rate, that's one thing. But even with a higher rate now, there's ways to maybe you can do a bi-weekly payment. So you have an extra payment or two per year that goes toward principal. So you're gaining equity faster. Or if you're able to make an extra $100 a month toward your mortgage payment. So hypothetically, if your mortgage payment with taxes and insurance, everything all in is, I'm just making a number up, $1,800, maybe you can make a total payment of $1,900. That extra $100 will go toward principal. So even on paper, you may have a rate of, again, hypothetically 6.75. But if you consistently make that extra $100 a month and or do a bi-weekly payment, your effective rate will be much lower. Again, you'll still have the same interest rate, hypothetically the 6.75, but by you paying anything extra toward the mortgage, it will make your I guess you would call it your effective rate lower.
Okay. This is the other thing that we're starting to see around also is buy down points. I was talking to an agent from the 80s who said back in the 80s they used to buy down so many points to get the rate from 17% down to like a affordable 10%. What is your thoughts on buying down points?
So I understand why people do it. I understand the allure of doing it. Personally, I'm not a big fan. So let's just use a $300,000 sales price, probably a decent loan size to assume in today's market. If you're buying points, it's a percentage of the loan amount. So let's just say, obviously 1% of 300,000 is $3,000. So if you're looking to purchase and you're bringing whatever it's 3% or FHA 3.5% or 5% or whatever the percent to the table, and whatever your portion of closing costs is, this would be another cost. So it's real money coming out of your pocket. So what we could do instead of that is kind of backtracking on what I just said. You take the higher rate so you don't have to come out of pocket with any more money, and you ask your lender to run what's called an amortization schedule. Hey, my budget, I can afford an extra $50, $75, $100, every paycheck. If you're able to do that and have the bi-weekly payment, you can accomplish buying points down without physically buying and spending the money. So I feel like you can get the benefit of what that would entail, but you don't have to come out of pocket with that extra money at settlement.
That makes sense because I know, like, if I need to buy a house right now and I only have, let's say, $3,000 from my moving company, and I'm not gonna hire a moving company. I'm gonna use that money to buy down points. What you're saying is like I can hire the moving company, and the money that I can amortize that amount. I can pay an extra $100.
Correct. Whatever the number is, your lender will be able to tell you. It's just a couple clicks of the computer on our end where we can tell you whatever, based on your budget. Hey, I can afford an extra 50, 75, 100, whatever the number is, whether it's per biweekly or monthly. We can tell you if you consistently make that extra payment and specify that it goes toward principal. We can tell you what, again, your rate on paper might be 6.75, but by doing that, maybe it's 5.875, depending on how often you're able to do it, if it's once a month or biweekly, and what that dollar amount is.
Okay. There was a chart that I saw when I first started in real estate, when it compares the loan and the life of the loan, the 30 years. And it says like in the first 15 years, most of the payments go towards the interest.
The interest is front loaded. The bank's getting their money up front before anybody else. That's correct.
Okay. And so by paying an extra payment, like I know some people do bi-weekly payments right now, which is one extra payment a year, or some people put a little extra money on every payment. How much money could somebody save in the long run?
So again, just roughly speaking, on a 30-year mortgage, if you started it, we're in December, so let's just say January 1st, you made your first payment. You did bi-weekly starting January 1st. You roughly would take that 30-year mortgage, and you did it for the life of the loan and never refinanced. You would take that 30-year mortgage and pay it off in it's like 24 months or 24 years in like 3 months. So basically, you take 20% off. And obviously, the more you can put toward, the quicker you could pay that down.
And if somebody can afford to pay a little more, maybe an extra month, two extra months a year, that will save him pretty much almost half of the interest.
Yeah, close to it. And again, that's something your lender, whatever that number is that you think or know you can do, your lender can run the amortization schedule, and tell you, hey, that 30-year loan will be paid off in 20 years, 18 years and 6 months. But yes, that's another way with the higher rate environment to get that done.
Okay. Yeah, because this is the thing that I always see in real estate, that the misconceptions that I see from buyers are that the price that you purchase price is what you pay for the house, and it's really not.
No. Yeah. That's correct. It's when you look at the amount of, in a 30-year, that's 360 payments. If you do the math, you might you're going to cringe when you see that amount, because again, like Jose said, the roughly almost the first half of the loan is front loaded, where the bank's getting their interest back. So you want to look at ways where you can cut that down and save yourself some money, as opposed to giving the bank all of the interest.
Because this is the other thing that I keep hearing from some people. The news always saying everything is gonna be bad, Chicken Little. The sky's falling, the real estate market is gonna crash and burn like it did in 2008, and prices are gonna come down. I personally don't see it going that way, but I see a little market adjustment, maybe like a 5% price reduction. But at the end of the day, if the rates are higher, it doesn't really matter.
No, and a couple things to maybe piggyback what you just said is big difference from 2008. Those loans weren't qualified. You had those stated loans, all the different exotic loans that were out there. The big difference now is everybody that's getting a loan in today's market, those loans are well qualified. So for the people that are talking about the doom and gloom of 2008, that's not going to happen just because of that reason. The people that are going through the lending and underwriting process now, for lack of a better word, they're vetted. The things we're asking for, the things we need, these underwriters are scrutinizing to prevent something like that happening again. So everybody's well qualified. So we're not going to see something like that. And additionally, just in the last couple of weeks, rates certainly have bottomed out. I don't know if this is long term or it's just this time of year, but they were, kind of pushing mid sevens depending on your scenario, and now they're back down into 6.5, 6.75 range. So I don't know. I don't have that crystal ball. I don't know if we've seen our high point or this is just a little lull, but they've definitely come off of their highs. That's for sure.
Speaking of this time of year, I'm glad you bring this point. We are ready to go into the holiday season. Christmas is around the corner. People are buying all the Christmas gifts and whatnot. And in some areas, like here in Maryland, it's getting cold. So, it's getting darker earlier and it's getting cold. So a lot of people always waiting for the spring market.
I think that's a mistake, but that's your area better because I think.
All right, tell me more about that, because that's what I was going with.
Yeah, I think if you wait till the spring, you're going to be waiting with everybody else when the weather's nice, and you're going to be competing with everybody else. If you're looking now, obviously that tells the seller that you're serious because, like Jose said, it's colder, it gets darker early. You have the hustle and bustle of holidays, so your seller probably knows you're more serious. And the flip side, if you're selling and you have it on the market now, that tells the buyer that these people are really motivated to sell. So I think it's a great time. And if you closed, let's just say, because we're a week into December, if you close January 15th, hypothetically, your first mortgage payment wouldn't be due until May 1st. So you could find a house, go under contract now, not close until early mid-January, and not have your first mortgage payment due until March 1st.
Yeah. I thought I was the only one thinking that way, but
no, absolutely.
It really makes sense, because this is the other thing. Reality and inventory is still very low out there, and in the springtime, probably buyers are going to be again competing with a bunch of other buyers, and some of these other programs out there that they run out of money right now, but they will have money in springtime, and they motivate some more buyers to get on the market. So I think for somebody who's moving right now, this is the best time, especially to put your house for sale. There's still a lot of equity out there. You have very little competition. You have strong, serious buyers out there. And you can get a good deal when you're buying something as well.
Absolutely.
You don't have to compete.
I agree with you there 100%.
Yeah. And even for the first-time buyer, this is a great time. Don't wait until next year, unless you must wait for financials or whatever reason. But if you can move now in the winter time, go for it.
Yeah, I think again, it sets you apart as opposed to waiting until April, May when everybody's out there. It gets darker later, and you're just you have more competition where you have less competition now.
Yeah, and it's fun to move during the snow. Trust me, I moved one time when it was snowing, and it was a lot of fun.
I'll take your word on that.
Well, Scott, I appreciate you for being here and sharing your knowledge with us today. I know this was very good conversation.
Absolutely.
And I'm looking forward to have you next year again, so we can educate our clients better on what to do with their loans, what kind of loans to get. I know as the rates and the market keeps changing so fast every year, we can have more conversations about this.
Absolutely. I appreciate it. Look forward to it as well.
And if somebody wants to get in contact with you, what do they have to do?
Email or call Scott Marsh. I work for My Mortgage, smarsh@mmi.com. I've had the same cell phone number since 1995, 410-375-3298.
Right. So we're going to have your information down. So anybody, look at the comments. You can pick up his information. You can call Scott. You can call me if you have any questions as well. We're here to help you. Again, have this Merry holiday season. I was going to say Merry Christmas, but I know we have some audience out there who are not Christian. So it's a merry holiday season and a great 2023. And again, we're always going to be here educating you, bringing some good information like today, so you stay informed and you can make the best decision when it comes to real estate. Bye, everybody.